Hi, this is Dustin, back with Dustin's Dollars, and today I'm going to be talking about Tellurian, ticker TELL, and in particular, I'm going to be talking about how they might structure their Phase 1 equity contribution for Driftwood Phase 1, and going to be doing this by looking back and seeing what Cheniere did in 2012, 10 years ago, when they were in a similar situation. I'm going to sort of go over um, quick recap of where they were and how that ended up getting structured, just so that we can sort of speculate and see what that might do to Tellurian, to the phase one cash flows for Driftwood in Tellurian, and and I also have one more thing I sort of projected, put in a little line item for what their operating expenses could be, so that we can have maybe an even better idea of what the uh, cash flows might be at operations for Driftwood LNG Phase 1. So before I go any further, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I do currently hold a long position in Tellurian. So basically this video should be for your entertainment purposes only, because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. So, um, first, real quick before I get into the meat of today's video, let me just recap the one. So we've seen Tellurian stock go up a bit over the past month. Shouldn't say a bit. It's been gone up quite a lot. In the scheme of things, I think the market is starting to recognize that the chances of the everyone's estimation of the chances of Driftwood happening are have gone up, and you see the stock price reflect that. But we had this gem of a video today from Shirisuki, and he's got a great expression. I pause him on right there, but I don't want to play the video because I don't know that the audio comes through, and that's not really what I want to do here. But I just pull up the one quote where he says, and I wrote it down, so I'll get it to the best of my ability, word for word. He says, financing this project is probably the easiest thing I've done in my career. And if that doesn't, give you some confidence that he's publicly saying this, I don't know what does. So that made me pretty happy this morning to see that. So, anyways, let's talk about Cheniere. So this is the Cheniere corporate presentation from January of 2012. I think I got that date right. I could actually go back up and see January 2012. There we go. And so they were in a similar situation to what Tellurian is in as of today. They were, let's find this timeline. Yeah, so this is where they were, right? They're saying, hey, we have, a lot of our stuff. We have commercial agreements, got our EPC contract. Tellurian has all of those. They're trying to nail down the financing commitments, right? And Tellurian actually already has their FERC. I think they have this, all the FERC stuff that they need. I guess they do, because they started construction. Tellurian has started construction, right? But it's the financing that's the big unknown, and the big piece that's going to let the whole project go forward with low risk. And if you look at where they were, right, they have a slide back here in this presentation showing you that they were pretty similar to Driftwood, right? The numbers are actually larger for Driftwood, but they were looking, to finance $3 billion of debt. And where does it say for the equity? They don't actually spell it out here, but it's by difference. They say up further up that it's $4.5 to $5 billion project. So they would be looking here in terms of equity, somehow getting $1.5 to $2 billion of equity. That was a state that Cheniere was in at the time. And so I thought it might be interesting and illustrative to look at what did they actually then do, right? This was this presentation was from January 2012, and then fairly soon after, we saw in February of 2012. Let me make this larger so you can read, hopefully read, where they entered in this sort of preliminary agreement with Blackstone to sell up to $2 billion of senior subordinated paid-in-kind units, right? So this was actually not just issuing common stock. This was not an at-the-money offering. They did sort of this private sale to Blackstone, and it was to sell approximately 111 million of these units for $18 per unit. Now, these did eventually convert into common units, and the conditions they originally had here were they would convert after two of their trains begin commercial operation. They expect to occur in 2016. And these units, as it says, are paid in kind, so they would have a quarterly paid in kind rate of 4.2%. So I think I did the math annually. That's comes out to like 18% per year, where they're just getting more and more shares on, because they're getting that dividend. It compounds quarterly, so that's pretty interesting. What I thought was this was interesting also because this wasn't actually the final deal that they went through with, right? And so just to compare these numbers, real quick though, I did want to say what should I be comparing that $18 against? And if this agreement, like I said, was as of February 27th, 2012, and I actually pulled the historical stock price for Cheniere Energy Partners. That's the units that they were getting here in February. And so if I look at the data from February, hopefully you can read this all the way up until February 27th, it was trading at $20, $21, right? So that $18 was actually about, let's call it a 10% discount roughly from their stock price. And you can see the day afterwards, things went up when they actually announced this agreement. But before the 27th, it had been trading around $20, $21. So that was a 10% discount. Not huge. Then the final agreement that they ended up getting was this one, I believe. And where's the PR from this? Nope, that's not it. This is it. They finally sold $1.5 billion to Blackstone. Cheniere Energy itself actually invested the other $500 million. I haven't looked up to see exactly where they got that money. If they were funding that from operations, because I think they did have an operating company at the time. I've never been invested in Cheniere. I haven't followed them super closely. Just to call that out. That's why I'm not quite as familiar with the details. I haven't done my full due diligence on them. But the agreement with Blackstone that they ended up getting was they sold to Blackstone 100 million units of these. They called them, now they had a name, the Class B units, for $15 per unit. These did accrete a compounded rate of 3.5% per quarter, also paid in kind. So that was similar, except at a lower rate from the other ones. But again, they only paid $15 per unit for these. And then these also did convert into common shares. I don't know where it's at here, but I've read it. They'll be subject to conversion into Cheniere Partners common units. And so it's similar, except the final agreement that they went is they actually paid less per share of the stock, but in return it actually had a lower paid in kind share accretion rate. So I thought that was interesting. One other just tiny bit out of there, they have the full. This is the same exact SEC filing from mid-May 2012, and they have the one thing here. Let's see if I can find it. I reloaded my tab, so it's not highlighted anymore. But they had something in here where they can say they can't actually, they can convert these units, but they can't sell them for 2 years. Let's see if I could find 2 years. Yeah, so they made an agreement that even the units that they get received upon conversion thereof, they can't sell them. They'll agree not to transfer for 2 years after the initial funding. So I thought that was an interesting bit that came out of that, right? And so that's something to think about for Tellurian in terms of even if somebody's sort of getting a discount on the stock, maybe they can't sell it for a certain period of time. And so maybe that was also part of how they got them down to, why they're paying less for these units versus the original agreement, was maybe this was an additional concession that they made that, well, you're paying less, but you're going to have to hold on to it for longer. So I thought that was interesting. And it is a little sad, though, if you look at how were things trading in May, right? They ended up on this price of $15 per unit, but by mid-May, and let's see, the exact date on this PR was, May 15th. So if we look before May 15th, CQP, Cheniere Energy Partners, was trading in, 23, 25, 26. So that $15 was a material discount. Blackstone got a great deal on those shares. And so that's a little let's say concerning in case Tellurian would do something similar. I have to imagine that they won't, given in the words of Sharif Suki, that the fundamentals, they've never been better on a global basis, right? Like they keep repeating that, and I actually buy into it. I believe it. That's why one of the reasons I'm invested in the company is that the macro picture is great, and so hopefully they don't have to make quite as many concessions. No, Cheniere was also in an interesting position where they were pivoting as a company, so maybe they also were in a weaker negotiating position. One could argue Tellurian itself is not in a great negotiating position, given that they basically don't have any operations, right? They have the gas operations, but it's minuscule compared to what they're trying to do with Driftwood. So you can make your own judgments there on how you think this might go. But what I then did to update my existing model that I had for the cash flows. Oh, one other thing I should call that out real quick before I get into that is I also looked at their. Oh, I didn't open it up. Let me grab it. I looked at the Cheniere 10Q filed in 2017 in order to get an estimate of what Tellurian's operating expenses might look like. And so what I did was I just looked at their yada yada yada. Let's get through here to just their statement of operations, and I was just looking at these numbers right here. Their all this stuff here, their SG&A, their operating expenses, and I put that into a line item here in my spreadsheet to guess, to estimate what these numbers might be. And I actually even added on 50%, I think it was, right? Because I think I added all these up, their operating maintenance expense and their SG&A. And then I added 50% on that. That was my rationale. Hopefully you can see, yeah, you can see that right there. So that was what I put this line item in that I didn't originally have when I went through Driftwood LNG phase one. My model for their cash flows. Again, could be way off. There's a lot of unknowns here. This is just my best stab at things. So I put that in, and to recap here, I have sort of two models here. This is two models here, one for 70% debt, one for 60% debt. We know that that's a critical variable in what the future cash flows are going to be, and then also the two sort of variables that they put out in their rough models in the investor presentation of whether they just buy gas on the market, sort of at Henry Hub, or whether they actually do some sort of an acquisition in order to get upstream gas. And unfortunately, one thing that I don't have in this model is any guess of what that would take in a share and what that means for their share count. So the share count is actually the same. So the cash flows look way better, obviously, if they are able to just do upstream production, but it doesn't, in reality, they would probably issue more shares. So, even this is sort of maybe, what would you say, an upper bound on that difference, right? You can imagine that if they issue more shares, this number here in terms of free cash flow would go down because it is, there's more dilution that dilutes that cash flows across more shares. But, all right, I talked a lot on that, but I didn't actually even explain the introduction of this sort of modeling of the dilution here. And so I figured if they now are able to dilute, if they were able to dilute right now at the $6 per share, and we divide that, we add that in the 70% debt model, they only need 30% equity, so they need about, per my, you can watch my prior video about the phase one Driftwood LNG cash flow modeling to sort of understand more of the assumptions built into this. But with the assumptions that I had, that's about $3.15 billion that they'd have to raise. And so if they did that at the $6 share price, you divide that all up, and then with my model of their cash flows and including the OPEX and the SG&A, that gets you down to free cash flow per share of $2.40 with phase one operations in Driftwood. So I thought that was pretty, still makes me happier and happier as an investor every time I look at it and I say, I'm holding the stock at $6 in a couple of years. It could have, $2.40 of free cash flow per share, just from phase one with sort of that optionality for the future phases. But if we look at, I put this in here as a parameter, right, so that I can then change it and say, well, what if they got, roughly a 10% discount off of that $6 per share price and they actually issued at, $5.40. That brings it down, but actually not horribly, right? That's why I have a model here where it brings it down in the 70% scenario. That brings it down to free cash flow per share of $2.27. Again, this is for buying gas right off the market at these, just fixed rates here. Fixed numbers, I should say, that I have in the model. And even the 60% debt case where they have to issue, more equity, and dilute more, you still, even at a share price of $5.40, gets you to, just slightly under $2 free cash flow per share at the, phase one of Driftwood. So that is kind of a rough update and sort of just my how I'm thinking about how they could actually structure this. And I'm going to have a probably future video. I'm toying with a future video that might touch on this if there's a little bit, if I can think through a way to actually provide some insight on Tellurian and the short interest and what that could potentially mean for the stock. But I actually think how they structure this equity is a big part of a big part of that thesis, because I know there's some people who are looking at this as saying, hey, there's not a small amount of short interest. It's not huge. This isn't 100% short interest like people were eyeing in GameStop a year ago, a year and a half ago, let's say. But I mean, given the violent upwards move that we could see, when they announce funding and sort of everyone wants to hop on board because it's pretty clear that this is going to be, paying out a lot more money in just a couple of years. That short interest could get a little squeezy, let's say. And so I do think that how they structure this equity, it matters, right? Because if there's going to be a bunch of shares that are going to come on the market very soon, right? If they hypothetically did an at-the-money offering and offered a bunch of shares, like there's no short squeeze, right? Because there's plenty of shares to go around. And again, that's not my thesis necessarily, and that's not what I'm even talking about today. It's just something I've been thinking about. One reason why I think it's a secondary reason that matters in terms of why it matters how they structure this equity contribution, right? The actual the effective share price that they issue it at, regardless of what types of units that it is, that's going to matter a lot for for the future profitability if you plan to model out the value of the company and hold until operations, and hypothetical future dividends way down the line. So all right, let's see, do I have anybody on the live chat? No, don't see anything. So just a quick plug, if you're still watching, I do these videos usually on weeknights, Sunday through Thursday. I try to have something. I don't always get it around. Some days I fail miserably. I have one per week, but I try to do this roughly on weeknights, sometime around, let's say, 9:30 to 10:30 Eastern U.S. Time zone. I'm not super consistent about it, but that's roughly the time that I'm able to get on and do this. So, if you're ever interested and want to hop on during a video, that's roughly when I live stream these. And I would love to have as many people want to join the chat. It's great. I've had some great back and forth recently with some folks, and so just something to keep in mind. So that's what I want to cover today. Thank you very much, and thank you for watching, and have a good one.